Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in delivering on Be Boring, Make Money. On this episode, we speak with U.S. equity manager Grayson Witcher. We discuss some team learnings over the past year, the sustainability of U.S. earnings, and some of the major position changes to the portfolio over the past 2 years. Thanks for listening.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
Joining us today is lead U.S. equity portfolio manager Grayson Witcher. Grayson, welcome.
Great to be back, Cam.
So today we want to focus maybe a little longer term on U.S. equity portfolio, talk a little bit about what's happened this year. But we want to mix in a discussion of kind of what's gone on in 2018 for the team, and then dive deeper into some examples company-wise. I think listeners are getting used to that kind of formula. When we have an asset manager in, we want to get as many specific examples out there as we can. So welcome back, and let's just get into it. Let's launch into it. So on an annual basis, and everybody in research kind of reviews the year and say, well, what did I learn this year? It's kind of a key component of, I think, our research process and the culture. So let's drill down into the U.S. equity portfolio from there, Grayson, and say, okay, in the last 12 months, the last 18 months, what changes maybe to the process has the team tried out? What's worked maybe best? And is there an example of something that maybe didn't go right and you just shelved it?
Sure. Yeah, we're always making process changes, trying to improve the process we have. So I'd be happy to share a couple of those with you. One of the things that we've tweaked more recently is looking at industries or looking at companies as part of an industry grouping. So rather than when we're updating, looking at portfolio holdings again, and we do that on an annual basis at the very least, kind of do a real in-depth look at the portfolio holdings. So rather than do that just randomly, we've grouped all the companies in the portfolio into buckets. And what we found, and we have one person look at all the companies in that bucket. A bucket could be payments companies like MasterCard, Visa, PayPal. So what we found is grouping them together and doing all that due diligence at one time allows you to go much deeper into the process and pick up on more themes that you may not have picked up on before. When you just hear one company, you may not pick up on it. It reduces duplication, whereas if you looked at Visa now and MasterCard in 6 months, you may have to kind of refresh yourself a little bit on some of the nuances. And so that's been pretty helpful from that regard. So that's something we plan to continue to do going forward.
I want to pause you there because I know our model as from a research platform standpoint is everybody's a generalist, right? So you know multiple industries. So what I'm hearing runs a little bit counter. So how do you retain that generalist knowledge but balance it with what I'm hearing as specifics?
Yep, still all generalists. A couple of things we do are we rotate these industries every 2 or 3 years. And so, maybe Stanislav works on paychecks and other payments business, payroll businesses for a couple of years, and then he'll rotate to Colin. So that gets a fresh perspective. So it's a little bit of a best of both worlds where you want someone repeating it a little bit so that they can use that knowledge they gained last year and build on that. But then it's also helpful to get a fresh perspective where someone may come at it from a different angle and say, yep, I see where you're coming from here, but when I dig into it, I see these other opportunities or other risks.
That's a good example. Thanks for giving that balanced view. Something that maybe didn't work, and it's worth trying, but didn't work, and why?
Well, one thing we tried was we had everyone on the research team look at a U.S. idea. And so this came out of a research retreat we had a little while ago, and we decided that we'd like a little bit of extra help on the U.S. to delve into some new ideas. And given that our research team, as you know, uses the same process, philosophy in every asset class, we speak the same language, so it's very easy to share ideas and to look at companies. We were able to do this quite easily. And so people in other asset classes like Canadian equities or international equities helped out by picking a company that they were excited about, that they thought would be good for the portfolio, that would add value, and took a look at it. And so like many ideas, there's positives and negatives. I don't think a lot of process changes, there's some things you can kind of pull out of it that are positive and some things that don't work. It's rarely just black or white where just everything doesn't work about it. So from something like this, I think what worked really well was just that collaboration that we don't always get between asset classes. So, I was able to sit on a call with Jim, who works on Canadian equities, a former CIO, and look at a company that he was excited about and delve into it and see, what kind of questions he'd ask on a management meeting and what he'd focus on. And so that was very helpful to get that perspective. So a lot of positives came out of it. I think some of the negatives were, one, for example, was it's harder to get that kind of follow-up. So when someone else on another asset class looks at a company, they kind of go back to the regular asset class after that. And so they may not follow that company as much kind of after that. And you lose some of that institutional knowledge as well. Well, they all wrote a report. So you have a 10, 15, 20-page report on that company. So that's very positive. And you can always reference that. And you can always walk over to the desk and ask them. But I think you do lose a bit of that knowledge where, everyone has a bit of stuff that they didn't write down on the report, a bit of knowledge about the industry and company. And so when they're no longer in kind of UST meetings, for example, you lose a bit of that knowledge. So, yeah, positives and negatives.
Another good balanced view. I'm curious, from that process of asking everybody in research to do one U.S. equity idea, is there any holding in the portfolio now that actually came out of that?
We did end up buying a couple. One is still in the portfolio, PPG Industries. So they're a paint and coatings company. So that's actually one that Seeing worked on. So she's on the Canadian small cap team and does a bit of work for the global small cap team, kind of more focused on Asian equities. And so, yeah, she suggested PPG, came up with the idea herself. It was actually one of those where we didn't put it in the portfolio right when a report was made, the suggestion was made. We all kind of sat down and we decided that the price just wasn't quite right. But we did add it several months later. The price dropped a little bit and we were able to buy it at a more attractive valuation. Management and business model were still excellent as they were before. And so that was very helpful.
Good. So just switching gears now, we'll go from a little bit of learning on our process and dig in a little bit on the reason behind the process. So we're hoping to beat a benchmark over time on each of our asset classes. So we're in parlance, we're trying to add alpha. So some variance above a benchmark. For U.S. equity, a benchmark is the S&P 500. My impression of that index is it has become highly concentrated over, say, more so over the last 2 or 3 years, which is where you get the acronym FANG from. So I just want to have a discussion, Grayson, around how do you go about beating the S&P 500 when the dynamics of the index are influenced maybe by a few stocks?
So maybe just step back a little bit and go back many years, many decades, actually. So I guess there's two parts of that. The good news about the S&P 500 is that it's one of the best performing asset or indices over time. So it's an outstanding place to start. I mean, you look at it over basically any time period. Look at it since 1980, 70, 90, and over every time period, it's outperformed the global benchmarks, outperformed the Canadian indices. It's outperformed the international indices, so kind of non-North American indices, by a pretty wide margin. So it's a great place to start. If you invested $100,000 in 1990, and say you're 30 years old then, and you were, just starting your career, you've got a little bit saved up, and you want to put some money away, you invest $100,000 in 1990. Today, if you'd invested in the U.S. indice, in the U.S. S&P 500, you'd have almost 2.5 times as much money as you would in the second best option in terms of other kind of global indices.
So absolute returns on the S&P 500.
Yes, absolute returns are much higher. Higher. Yeah. Okay. So that can make a pretty big difference. Like I said, if you invested $100,000, you'd actually have $800,000 more in your bank account now than you would investing in any of those other indices. So
I wasn't far off that. But the only thing missing in 1990 for me was $100,000.
That's right. That's all you needed. That's all you needed.
Because I should have gone out and borrowed some. Anyway.
Yeah, so it makes a big difference. So I think that's a great starting point. But to get kind of further down the path in your question, great benchmark. So some great companies in the U.S., I think. And I mean, the reason that's performed really well is because there's really great companies there, great management teams, great businesses. They benefit from a lot of these kind of global trends. You're not just betting on the U.S. market, but you're betting on some of these international companies, the Nikes of the world or Pepsis that sell products all over the world. How can we beat that? It really comes down to our process. I mean, that's, I guess, the simplest answer to it. We want to invest in the right companies and the right part of the forest, and so that's a big part of it. So we're looking for business models are important, and so when we think about what we could invest in the U.S. is even if we can exclude, the bottom third of the companies out there, the ones that don't make any money right now, that are less attractive, that should skew your returns a little bit better. And I think our process does that. Investing alongside great management teams makes a big difference, especially for long-term investors like us. When we're trying to think 10 years out, management makes a huge difference over that period because they're reinvesting that capital and making a lot of decisions for shareholders. And so that makes a big difference. And as you know, we speak with between 250 and 350 management teams a year. And so that's one way we just get better and better at doing that. It's just another case of kind of practice. Those 10,000 hours make you a lot better at that. And so
pretty much one a working day.
Yeah, it's very close to that.
Sounds like it. Yeah. Okay.
Yeah, and then pay a reasonable price would be the last part of that. So yeah, it comes down to our process philosophy, and I think that enables us to strive to generate alpha.
Okay. So I mentioned an acronym, and based on your answer, one, I want to explain the acronym, but also walk through maybe a couple of them and as to why we own it or why we don't, right? So FANG is Facebook, Apple, Amazon, Netflix, and Google.
That's right, yeah.
And you could add an S there somewhere, but what are a couple of those you could pull out and say, well, we own this because it matches our process, and our process eliminated this one for whatever reasons?
So we do own, of the FANGs, we own Amazon and Google. I would say generally in technology, our portfolio looks quite a bit different than the benchmark. I think that comes back to process. And so Google might be one example of one that's fits our process better. So Google generates a lot of cash flow right now. So that's great. That's what we're looking for. We're looking for companies that generate cash flow now and hopefully generate more in the future. A lot of tech companies right now do not generate any earnings or cash flow because they reinvested back in the business. So if you're investing in those type of companies, you really have to believe that they're going to keep those customers, one, keep that business, and two, they can then start to generate cash flow sometime in the future. So those are two big ifs. And so you'll see we don't tend to invest in a lot of companies where you have those two big ifs because it's hard to know 10 years out, is this company going to be able to keep all these customers? Technology changes quickly, so it's not so easy to determine that. And then are they going to be able to switch their business model so they can generate way more cash flow in 10 years than they do now? I don't know, take a simple example, like go back 10 or 15 years, maybe even 10 years. A company like Yahoo would have been pretty dominant. It's kind of almost laughable now. You think about Yahoo, probably nobody uses it. Their email, their Yahoo Finance.
Is that the You've Got Mail?
Yeah, or AOL, these companies, yeah. So,
right.
So these, but they were pretty dominant at the time. If you kind of go back then, you'd think that people said very similar things about Yahoo.
For sure.
Well, you go to Yahoo for everything. You go to it for sports. You go to it for football pools. You go to it for finance. You go to it for email. And so who's going to unseat them? But things can change quickly. And so we like to keep that long-term perspective in mind and say, okay, people are pretty positive on some of these tech companies now. Is that going to be the case in 10 or 15 years? And so what you'll find in our portfolio is we tend to invest in companies that generate cash now and hopefully generate cash more in the future. That's
a great segue into getting a little more granular in terms of cash flows in the U.S. market. Just want you to comment on the sustainability of U.S. earnings, particularly in the face of drops in tax rates, tariff every day type world. Share buybacks are at peaks. So how does the U.S. market keep that advantage that you spoke to earlier?
Some of these factors are no doubt important. I think the main driver for the U.S. economy is just going to be the economic cycle, the credit cycle. So things like lower taxes are going to help on the margin. Tariffs are going to hurt on the margin. Tariffs are basically a tax on consumers in many cases. It can be tough to move production around from China to other regions, and so you just end up paying the tariff. And as a consumer, if you buy a new suitcase, you may end up spending 20% more for that suitcase. So it's really just a tax on consumers. But yeah, so I think some of these factors, buybacks, are important, but the big driver is going to be the economic cycle and the credit cycle. So that's something to watch. To put it in context, I guess, reasons why the U.S. could continue to do well. It's really hard to predict when it's going to be a recession. It's not something we think we're especially good at, or anyone. It's very hard to know. What you can know with, I think, a little bit greater certainty is some of the structural advantages of a market. So the U.S. has some pretty significant structural advantages, such as these clusters of knowledge. So it's things like Silicon Valley. It's very similar to Canada might have things like the oil sector in Calgary, where there's a big congregation of oil companies, and the knowledge around there, very similar to Silicon Valley. Many of the best companies in the world are based in Silicon Valley. You could see other things. You could say the same thing about healthcare technology or genetics or biotech in the States. It's in kind of Silicon Valley or in Cambridge, Boston area. So these are pretty big advantages, long-term advantages when you have this knowledge base. The U.S. is an entrepreneurial environment, so that helps a lot. Yeah, so there's many kind of long-term structural advantages that the U.S. has that I think can lead to some pretty big advantages. One other thing to keep in mind, too, is the U.S. is, or at least has been in the past, a reserve currency, and it probably will be in the future. And so for investors, such as Canadian investors, this can be a pretty big positive, where in a big recession like you might have seen in 2008, people get very worried and they move their money to real safe havens like the U.S. or the U.S. dollar, because they're worried about emerging market currencies or other kind of riskier areas of the world. And so for the U.S. equity fund, that was a pretty big benefit. It was about 16 percentage points. And so while the local currency returns in that environment were about minus 30%, pretty similar to different asset classes throughout the world, the returns for Canadian investors were just under 15%. And so that's a pretty big benefit. And so that can also help when you're investing in the U.S.
Okay. You covered a lot in that response. It's awesome. Let's walk through some shifts you've made in the portfolio. So, and I don't want to talk about like last week or the last 3 months. Like let's think a little longer term and go 2 years. I dug around a little. I'm a little bit of a researcher, so
2 years is short term for us, Cam. We'll stick with that though.
I'm gonna pin you on 2 years, Grayson, just because that's the only place I got the numbers from. Anyway, I pulled the top 3 positive position changes. So this is just trades that you say I want more of this stock or less of this stock, and the most negative changes. So the top one is car auction services, and over the last 2 years, you've added almost 200 basis points, so 2%. To that one from a weight perspective in the portfolio. And then maybe an interesting one to speak to on the bottom would be the largest one would be over 300 basis points or 3% out of Cinemark holdings. So let's just compare and contrast those two business models. Why have you been adding to it over the last 2 years? Why were you trimming?
Car auction is an auction business, so it's a great starting point because auctions just have a real strong competitive advantage because you have the buyers and the sellers have to come to kind of one spot to
and what do they auction?
Sell. And so car auction auctions cars.
Yes, but I'll point out
different spelling
that the company name is spelled KAR. So
it's genius.
There you go. Sorry, I just wanted to clarify that.
But they auction 2 kinds of cars actually. So they auction new cars. And so if it could be things like a car rental company. So you think about a big fleet of companies, a car rental company might have thousands of cars that they need to sell every year. So they will use a company like Car Auction to sell those cars. They also auction salvage cars. So if you've been in a car accident and your car is a write-off, they'll sell those and people will buy them. Dismantlers will buy them because often there's some value left in them. It may be the front's banged up, but you can take the engine out, part of the engine, or you can take panels off the side or the wheels. And so there's value to that, or you can sell it for steel scrap. What's interesting about this business, I'd say a couple of things. One, we owned a competitor of theirs for a while, Copart. So this is the other big salvaged auction company. There's really only 2 of them. And so we knew the industry pretty well. And so that was one way that we were able to find this interesting investment idea, especially given that it's a little bit off the radar screen. It's just not a well followed, covered industry because it's kind of strange. It's just there's not many car auction businesses. There's no kind of obvious industry to groove it into. And so that's something that's attractive to us. We're trying to find things that are a little bit off the radar screen where we can find great opportunities. And so that's how it came up. It also, interestingly, was part of our initial U.S. reverse roadshow. And as you remember, that's where we went through every company in the U.S., a little over 6,000 companies, one by one, and screened them to try and find new ideas. And so that also was part of that process. And so while we didn't invest immediately, we did invest in it not too long after that. And why have we added to our position over the last couple of years? Pretty similar to what we've been talking about so far today. It's a great business. Like I said, it's auction business. It's a really strong competitive advantage. It's really hard for new entrants to get into that business and unseat them. So we think it's a long-term sustainable business model. Management is great in our mind, very high quality management team. We've been impressed with them and what they've done over time. And so that's been another big positive. And when we found the right valuation, we've added to it over time.
Yeah, it's a great description. Now let's flip gears and go, okay, well, here's a holding that's been reduced quite a bit. Why? What does the company do? So Cinemark Holdings.
Cinemark is a movie theater, kind of like Cineplex, I guess, in Canada, where you go and watch movies. They're one of the biggest in the U.S., and they also have a business in Central and South America where they do the same thing. This idea originally came from a trip I did to Texas several years ago. And often when we travel to new places, we'll screen every company in that region. You probably heard Paul or others talking about this when they go to different parts of the world. And so we do the same thing in the U.S. I was going on a trip to Texas, to Dallas, and to Houston, and screening through other companies in that region and found this company that we had looked at in depth before. So that's how it originally came onto our radar screen. And so since then, we visited their management team several times and got to know them quite well. The reason we've been trimming that over time is a couple things. So I guess to put it in context, there's always risks with movie theaters. If you think back many, many years, people were saying, well, there's now big screen TVs. You can have a 30, 40, 50, 60-inch TV in your house. So why would you go to movie theaters? There's always things like this that pop up, or the original Netflix DVD rental business where you say, well, look, I can get a movie, to my home and play it. So why would I go to the theaters? And so I think it's good to put in that historical context where there's always worries with these kind of businesses, and they tend to get through them because people want to go out and socialize. That's a big part of it, is you want to get out of the house and you want to see some friends. So it's good to put it into context. Part of the reason we've been trimming over the last several months, though, is they made a few changes, and I think those changes have been somewhat recognized by the market. And so the stock has done reasonably well over the last several months. And some of those have been putting recliners into their theaters. That's worked out reasonably well. Being able to reserve your seat ahead of time so you don't have to go 20 minutes early and sit in your seat and watch ads for 20 minutes. You can book your seat. And concessions have improved a lot. When I was down visiting them last time, I walked through one of their theaters with someone from the company, and you could see how much easier it is now to go to the movies. You can just pick up the popcorn or the licorice yourself and quickly pay for it, and it's not a production. So they have done a lot of things that have made the experience a lot better over time, and I think that that's starting to be recognized by the market. And of course, the movie slate is always a factor. What movies people like watching, that goes in kind of shorter cycles. But it's a combination of those several factors have led us to trim it, as well as worries about Netflix and other kind of threats to their business that may challenge them. So combination of valuation, market recognizing some of these benefits, and then some of the risks looming out there led us to trim the position back.
Great context. I was just jumping right to the fact that I can just watch from my streaming service and invite friends over, and I know how to make popcorn and save a boatload of money and be comfortable. But people still go to the theater. It just depends what the movie is.
Your kids probably go to the movie theaters to get out of the house. They don't have to.
You very well could do that just to get away from me. Yep, for sure. So we're getting more specific. You're giving us some good examples. So why don't we close out just talking a little bit about the top performer and the worst performer in the portfolio. Okay, so let's start with the worst one, Grayson. LKQ is down almost 30%. And it's currently a small holding at 58 basis points in the portfolio.
So LKQ, it used to be a much larger weight, and we've been trimming over the past number of months. There's been a few reasons for that. One of the members on our team, Stanislav, was actually down in Chicago a few months ago and met with the management team.
Pause you there. What does LKQ do?
LKQ is actually a dismantler. So we were talking about car auctions earlier on. And so Car Auction will sell their salvage cars to LKQ. So this is, I guess, another example of how that kind of knowledge in a little niche industry has led us to other ideas. So LKQ will buy those wrecked cars, and they'll take them apart and sell them.
So they sell the parts?
They sell
largely a parts business.
So it's like a pick apart. If you go to a pick apart kind of yard, they own yards like that. So you can actually go off the street and buy a single part if you want.
Okay.
Or they're using them more now for if you get an accident, rather than buying a new part, you can buy a part that's from a car that's been dismantled that is in good working order and put it in your car and save your insurance company. Your insurance company saves money doing that. So they like that.
Great. Good picture there. Sorry, Stanislav went to Chicago management meeting. Over to you.
He met with them, and this is part of our process. As you know, we go on research trips relatively often to just learn more about these businesses. And so Stanislav did that and came back with some great insights about the company. There's been a management change with the business several months ago. We thought the old CEO was a high quality individual. The transition, we were a little bit worried about the transition to the new management teams. Our management ranking was a little bit lower with the new management team. So Stanislav went down and tried to learn a little bit more about it and speak with them and delve into different parts of the business. So the combination of those two factors led us to trim over the past several months. And the valuation kind of through luck or skill was when we started trimming was quite a bit higher. And so we were able to reduce our position substantially before we saw the drop off in share price. And we were cognizant of the business model. It's a bit of a roll up business model. So they've been acquiring a bunch of companies over time. And so I think that's been a factor that's always been in the back of our minds. And when we talk about this company in terms of risk, that's always come to the forefront. And so it's just a little bit riskier business model given that it's a roll up strategy. And so I think we were a little bit more sensitive to some of these changes in terms of management and valuation. And so you had those kind of two main factors, maybe 2.5 factors combined that were pointing us in the same direction that led to the sell decision.
Let's switch it over. It's tough to talk about losers and maybe more fun to talk about winners. So the top performer on the upside is MasterCard. We've talked about this one a lot in past podcasts. We like this business model as a firm, but we also talked about position changes earlier in this podcast, and MasterCard was actually the third largest reduction in weight over 2 years. So let's walk through that. Grayson, it's still performing, but we're reducing.
So MasterCard, yes, it's been a great performer for us over the last 2 years. I think it's up around 35%. And actually, if you step back, we first invested in this business model back in 2010 when we invested in Visa. And the original reason for investing was that we believed that the market didn't quite understand how Visa worked. Visa and MasterCard are the same business model. So they didn't really understand how it worked. They thought there was some kind of credit exposure to it, didn't realize it was just a payment processor and the banks are the ones lending credit to the individuals. So I think that's a little bit better understood now. But the business model has played out fantastically well with those business over time. We own Visa only for many years, and several years ago we added MasterCard as a running mate to Visa.
That's a pretty strong return, up 35%. How do you explain that?
So what's driving that strong performance is really the shift from cash to cards. And so that's what attracted us to that business model in the first place, is that long-term theme. Those are some of these themes that we like to invest behind, or themes that play out over 5, 10, 15 years. And so that's something that we saw with Visa earlier on, and we saw the same thing with MasterCard. And so that's why we've stuck with that. We've owned Visa for over 8 years, and MasterCard we've owned for a little bit shorter, but we like those long-term themes. And so when you think about your own personal habits, probably 10 years ago, you were using your credit card a little bit for different purchases, but now you probably use it all the time. For myself personally, most of the time I don't have any cash in my wallet. I don't need it. And so you think about that transition over the past 5 or 10 years, it's been massive. You really don't need cash to do anything in the economy now. On top of that, you benefit from the theme of e-commerce. And so obviously if you're buying something on Amazon or some other website, you can't pay with cash. And so by default, you have to use a credit card, and that helps MasterCard and Visa even more.
The more transactions, the better it is for Visa and MasterCard.
Absolutely. So they clip a little bit of each transaction. It's not a huge amount, probably 20 cents on a $100 transaction. So not a huge amount of money, but when you think about the billions of transactions that happen every day in the world, that's a good thing for them. And you think about the number of transactions when you're buying lunch or you're paying for parking. All these small transactions just are a big benefit for MasterCard.
Okay, so why trim it? If it's that great a business model, the outlook looks good, everybody's going electronic. It's going to lead to increased transactions. Revenue's going to go up. Profit's going to go up. Why sell it?
So part of that's been a shift from MasterCard to Visa. And so our weight in MasterCard was a little bit higher, and we decided that from a relative value perspective, these companies are very, very similar. And so we just thought there's a bit of a gap in the valuation between the two that was unjustified. And so we switched between the two. So that's a big part of it. And the second part of that would just be to trim our exposures. So we're always looking at these things from a risk management standpoint, because, we're very focused on risk-adjusted returns, not just flat-out returns. And so when you combine the two of those companies together, they were a pretty big weight in our portfolio, over 6% of the portfolio, and partly because we've added them, but mostly because they've done very well over the past 5 or so years. Just from a risk management standpoint, thinking about, okay, valuation is not that cheap right now, and from a risk management standpoint, just how much exposure do we want to have? Yes, it is a very good theme, but we want to think about it from how much risk do we want to put in this business model.
So Grayson, thanks for all that detail on the portfolio. It's time for one more thought. Hope everybody gets that pun now, but one more thought. And we started the conversation talking a little bit about team learnings. So give us a final impression of it. Like, where is the team at now? What's working? What's the team dynamic like?
Well, one of the things I like best about the U.S. team is just the diversity in thought and background. I find that leads to great discussions around team meetings, because everyone comes at things from a different perspective. We have four people on the team that are fully dedicated to U.S. equities, and each one of those people grew up on a different continent, which is pretty amazing when you think about it. And we've had some great discussions at meetings or even over lunches where we post some of our good discussions to talk about things. And you just get a very different perspective. For Stanislav grew up in Russia and Siberia, just a very different perspective on things than Colin, who grew up in Asia, or Amit, who grew up in the Middle East. And so it just leads to different perspective on life and investing. And I think that's a big advantage for our team.
Awesome. Thanks for sharing with us. I'm sure we'll have you on a third time, or a fourth, or a fifth.
I hope so.
Thanks for spending time with us, Grayson, and over and out on U.S. Equity. Hey everyone, Cam here again. To subscribe to the Art of Boring podcast, go to Mawer, that's mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.